Three, two, one. Yep, here we go.
Good afternoon. Welcome to the second podcast about the Cormark-Corton Quantitative Opportunities Fund as we bring you up to speed after another successful month in July. And I'd like to say thank you for being here. And I'd like to introduce Mark Darriott to speak to the performance for the month of July. Without further ado, Mark, over to you.
Okay, thanks a lot. So yeah, we thought we'd provide a bit of a market update. We will upload a larger deck to the Corton website that has a lot of insights on market trends, and I'll just highlight a few of the slides from that deck, and then we'll talk about how the fund is positioned currently. So the bullish trends remain in place, and we see upside for the S&P towards 6,700 and then 7,000. The market is finally taking a bit of a breather here. We think it's a pullback within an ongoing bull trend, but we have taken the first kind of precautionary step in a while. So firstly, the disclosures for compliance. I'm an officer and director of Cormark Quantitative Analysis, Inc., or CQA. It's a wholly owned subsidiary of Cormark Securities. And CQA developed the quantitative models, have been licensed to and implemented by Corton Capital. Corton is the IFM and PM of the Cormark-Corton Quantitative Opportunities Fund, and its underlying fund, Cormark-Corton Quantitative Opportunities Fund LP, each a related issuer of CSI and Corton. So that's a mouthful. So let's flip through some of these slides quickly. So here we show our kind of intermediate term indicators, our red lights, green lights, if you will, and still most of the indicators we watch are in the green, which is important. So again, an ongoing bull trend. We don't have typical warning signs that we see ahead of a market top. And then the global equally weighted index is just coming off the highs here recently. It flipped positive, the trend in early May, a bit ahead of the S&P. Hasn't made an all-time high yet, but the fact that this line is going up means that there is good participation globally. This index has about 20% weighted to China, by the way, so it's much different than the market cap weighted index. The S&P, if we zoom out to the monthly chart, we just get out a ruler and draw this channel. The next upper end of this channel comes in roughly at 7,000. That's our intermediate term upside target. And then the weekly chart, so a few weeks ago, this momentum indicator turned on, if you will. Think of it as an on-off switch. When this pushes above 60, that's a bullish sign. And we went back to 1896 and tested this, and the subsequent average return for the market is 21%, and the duration is 20 months. So it's kind of confirmation of a cyclical bull. You can see the green lights, the green circles are on, and the red circles are off. So that suggests a confirmation of a bull trend. The daily chart just last week finally broke its first line of defense here, the short-term support. The orange line is a 21-day. The green line is what's called a trender. It considers the volatility of the market. Both of those broke, so we're in this kind of corrective phase, and the obvious support doesn't have to get there, but it's around 61.40. That's the breakout level in the rising 50-day, which is in blue. So corrections are normal. You get them several times a year typically, and we think that's the stance that we're in right now. And on that 21-day moving average, the green bars here show how long the S&P has been above it, and until it flipped below on Friday, it was 62 days. So you can see that's quite stretched, 3.3 deviations versus its history. And we went back and looked at all the other periods where it was extended in duration, going back to the 1940s. And these are the drawdowns that happened subsequently. So on average, they're a bit higher than is typical for the buy and hold of the S&P. So it just pretends maybe a choppy period ahead in the near term. If we consider broader context, the green bars here show how long we've been above the 200-day moving average, and that's still actually below its historic mean. So the bull market can continue for quite some time. it's just taking a pause, if you will. We're going to talk about breadth again. The top chart here shows for the S&P percent of stocks that are in a bull trend, just measured by is the 50-day above the 200-day. And it's just above neutral, 64%. And that can continue to expand. Usually gets above 80% before the bull is over. So more stocks can join the party. And then we don't have warning signs in terms of new lows. This red bar shows for the Russell 3000 how many stocks are making 52-week lows at a given time. Last week it expanded a little bit, but we use 10% as kind of a warning sign that underneath the hood there's more damage than we'd like to see, and that's not the case yet. We're going to flip a little bit further here. Sorry, this slide here. Yeah, this is our tactical Baker's dozen. So there's 13 shorter term indicators that rolled up into one. And the red line here. This got quite stretched off of the lows in April. So we back tested this, and the best time to buy is when we're below 10% on this index. And then when we get above 85 and start to fall, which is the mode we're in now, the subsequent 1 to 3 month returns, they're not terrible. You can see minus 0.2%, for instance, for the 1 month, but they are below average. So it's just another indicator to kind of take your foot off the gas in the short term. Beta, in terms of factors, remains quite strong, but it too got maybe a little too strong. So this chart here shows the ratio of high beta to low vol. In April, this momentum indicator got as bad as we saw during COVID. You can see these green circles and the big dive that it had in favor of low vol. Now we're at the opposite end of the extreme, where high beta has gotten quite stretched versus low vol. Just another indicator that the risk reward here on a short-term basis is not the greatest. So we're going to leave that now and look at our fund fact sheet for the month. So we were up on the month. The F class was up 1.65%. That's net of fees. TSX was up 1.5%. We've initiated some market protection, if you will, through inverse ETFs. That was triggered on July 31st, just a day before we had that 1% down day last Friday. So we have a bit of portfolio protection on. We Also had some inflows, which I'm not complaining about. So we have some cash to put to work at the end of the month, around 10%. And we also got stopped out of some positions later in the month of July. So those three things combined have reduced the beta of our portfolio from around 1.2 times to 0.64. So we will be putting the cash to work as we get through earnings season, looking again for companies that have big earnings beats, that have positive trends in terms of their profitability, that are breaking out of timely base patterns, and so on. So we will be putting that cash to work. But we've gone from a more aggressive stance to, in the short term, a bit more conservative. So far since inception, these are some of the stats. We lagged coming out of the gate in May, if you recall, because we were in heavy earnings season there. We decided to take it conservatively rather than step on landmines out of the gate. So that was a drag on our fund in the month of May. But the downside volatility is lower. The upside capture and downside capture are attractive. So the fund is performing kind of in line with expectations. For the month of July, the biggest sector positive contribution was industrials for the second month in a row. MDA, BDI, and Badger were the top three contributors. And then financials were the largest detractor: Trisura, AGF, and Dominion Lending. So we, in this fund fact sheet, we have the sector weightings. So we're biggest overweights are financials, technology, and industrials, and then discretionary and gold. So sectorally still leaning towards offense over defense. And we just highlight again that tactical indicator that we covered in the package, that it's stretched. So maybe in for some choppy more muted returns in the short term based on the history of these indicators. So we'll leave it at that. And hopefully, if you have any comments, feel free to reach out to us. Our contact information is on page 3 of this fun fact sheet, which we'll be shooting out to everyone. And we look forward to chatting with you next month.